Now, on to today's market movers with easy-to-follow futures and options trades from CME Group.
Welcome to Market Movers. I'm Jim Urio, and today we're looking at November's unemployment numbers that are going to be released on December 7th. We're looking at using E-mini S&P options to hedge risk or create opportunities in this extreme volatility. Joining me is Chief Investment Officer at Kingsview Asset Management, Scott Martin.
Hi, Jim.
Okay, does unemployment even matter this month, considering that we're up all over the place on things like China, on things like the Fed? Thoughts?
And psychologically, it seems like the market's all over the place. Here's why I do think it does matter, Jim, because of the fact that we can't have an outlier here. Right. In the sense of the market actually being able to rely on something that's stable, as far as, you know, the usual numbers that we see out of unemployment, say around 175K jobs added for the month, that would be great for the markets to maybe calm down a bit here.
Interesting point. So all we need is some stability. We don't need it to be great. We just need it not to be bad. Good. Now, what about China? Do we need a resolution before we go through those 2840 highs from November and October and start higher?
I think a resolution would be great because of the fact that, again, it would drive back in some stability, maybe some normalcy for the market to operate, because psychologically it's all over the map. However, maybe the pressure is off slightly with respect to that, because it does like we're making some inroads here.
Okay, now before we dive into our trade discussion, I'd like to point out with all market movers, it's important to view these as examples that allow you to see different ways to use futures and options products to either manage risk or create additional trade opportunities, not as recommendations or advice. Prices and movements will vary. When we price this out, stocks were all over the place, but we pinned these to about 26.54. Scott?
Yes, pinned them to 26.54, which means that was basically a few minutes ago, and now the ES has moved again another 20 handles.
Right,
yes.
Yeah.
To your point, though, earlier, Jim, or maybe it was mine, psychology is really first and foremost right now. So when I'm looking at some of the charts and looking at some of the price action, I believe there's some really great value in having the futures market to help us hedge, help us get around the clock access, and basically get us that pure exposure that you want, either bullishly or bearishly, to the ES underlying. So today, Jim, I found something in this very moment. I found something that I liked in the sense of the week 2 DEES, 2650, 2700 call spread for approximately 24 ticks. This trade is going to risk 1200 to make a potential 1300, as I believe this bearishness is getting overdone. And if you want to express yourself bullishly here, I think this is a nice little opportunity to have some of that exposure to the upside in the ES. I like this trade a lot, because basically what they're telling us, because the bottom strike of the call spread is basically right where the market is now. Correct.
And we have a week and a day, and the question is it going to be 50 ticks lower or 50 ticks higher in that time? They're saying the answer to that is yes. If you can get that any lower than a 1 to 2, I think it's a pretty good buy.
Thanks.
Yeah, I like the trade a lot. I'm looking at it a little differently. I'm going to be selling volatility here, because volatility popped up. At the money, volatility is about 29 and 50 right now. So I'm looking at selling the week 2, the same expiration as yours, the 26 even, 25.75 put spread for 6 ticks. It risks 950 to make 300.
Wait, this is not the usual Jim Urio I'm used to as far as the risk reward. Talk to me.
Because what the market's telling us here is that you are probably going to collect this money. It's 50 ticks away from the top strike of the put. If you don't, you can lose money on this, but your loss is defined. The reason I want to be more of a seller of volatility is because that pop we talked about, 29.92 is actually at the money volatility.
When you sell,
and by the time we finish this sentence, it's probably 35.
That's probably true, right? It may look good or worse, but the reality is right, Jim. When you sell volatility like this, it's nice, at least from my aspect, to have a short expiration ahead, in the sense that we're a handful of days plus until the trade expires, so therefore that's a good expression.
Last question, quick answer. The Fed normally puts as high level importance on unemployment. Is it less or is it the same as normal?
I believe it's the same, in the sense that if the number comes out on track, it allows the Fed to stay on track, which I believe is very key for the market psychology here.
Gotcha. Thanks for joining us on Market Movers. I'm Jim Urio, where we're helping to make you a better trader.
Check out businessfirstam.com to find out where to see our entire show. And don't forget to like, follow, and share Business First AM.